Hey, good afternoon. I hope you had a great 4th of July, maybe a great long 4th of July weekend for those who had a couple extra days there. We have a lot to cover. Although this was a holiday week and markets were closed on Tuesday, certainly was not a shortage of information coming out the last week or so. So we had a bit of a bookend with a lot of data coming out on Friday around income, spending, inflation. And then here we are on Thursday with a lot of jobs data coming out. So we're going to get into all of that here this week. My name is Brandon Steele, financial advisor with Mainsail Financial Group here in Bellevue. And our goal every Thursday is to bring to you the market news, the data, and some of the trends that we are watching, and hopefully weed out some of the noise, along the way here. So again, a lot to cover here this week. And for those who do listen to us weekly, you may know from a couple of weeks ago, we actually covered this kind of concept that during the summer months that trading is typically a little bit lighter. We have a little less volume, less activity in the markets. Doesn't mean that swings can't happen. It just means there are less people actually buying and selling. And so that certainly has been the case if we look back to last Friday, heading into kind of the holiday weekend here. And in fact, because of the 4th of July landing on a Tuesday this year, we actually had a half day on Monday, full day off, on Tuesday. And then even on Wednesday, markets were actually pretty muted as well, with just not a lot of activity, not a lot of movement, which was a little bit of a nice breather, I guess. But here we are on Thursday and we're right back to some volatility. So even though there was a little bit less activity this week, there certainly was not a shortage of information. So if we go back to last Friday, we had income and spending come out, but maybe most importantly, we had PCE data come out. In other words, another measurement of inflation. And for those who do listen to the Fed press conferences or listen to us sharing what the Fed had kind of stated in their conferences, really their main focus is around this number. They really talk a lot about this PCE index, not necessarily CPI, but rather PCE. And I'm going to focus on one of those numbers here this week because it's the most important, and that is core PCE. So again, Fed, every time we hear them, they really focus on PCE and more importantly, core PCE. That's why I want to focus here. So core PCE index rose 0.4% again through the month of June there. And that puts us at an inflation rate year over year in core PCE of 4.6%. So, this is certainly not anything notable, not a big drop, nothing like that. However, the markets were really focused on the headline number. So there's core PCE and there is PCE. And the PCE number showed year-over-year inflation dropping from 4.3 all the way down to 3.8% just in this last month alone. So the question is, what is the difference between core PCE and this headline PCE data point? And why does the Fed care about core more than the headline? The reality is basically that the headline number is a basket of goods and services, and there's a lot incorporated in there. But I'm going to really simplify and just share that the core PCE data point really just strips out food and energy. That's probably the easiest way to put it. So food and energy prices can be very, very volatile, right? I mean, look at the price of oil. Now, we don't necessarily see that at the pump here, but the cost of a barrel of oil has gone down quite a bit, let's say, for quite a few months here. So that is why the Fed really focuses on this core PCE data point, is that it strips out some of the volatile pieces. Because let's say oil, there's production cuts continuing. Let's say oil prices spike. That can also go the other way as well very, very quickly. And so the Fed really wants to focus on this core PCE data point because generally speaking, it's a better measurement of kind of where things are actually headed. And it strips out some of the more volatile month-to-month items that can change pretty quickly. All right, so this is really important because although this headline number came down quite a bit, the core PCE number really did not. And the markets certainly seemed to like it on Friday. But, again, I think we need to take that with a bit of a grain of salt because the Fed, in all honesty, doesn't care a whole lot about the headline number. I'm sure they factor it in, but their focus is on the core PCE data point. All right. Now, fast forward to this week, we got a lot of jobs data. We had ADP employment reports come out today, and it shows that we added 497,000 jobs in the month of June. This is only versus expectations of only like 220,000. And last month we added about 267, which was higher than expected then as well. So this data point, to be very clear, is big. I mean, this is a giant jobs number for the month of June. And on top of that, we had initial jobless claims come out today, basically the same as last week, and job openings still at like 9.8 million job openings. So, the gist of it is that the labor market is showing that it is still very, very strong, and the markets are kind of pulling back as a result of that, which I'm going to address in our question of the week, which is kind of like why the Fed cares about reducing jobs and really like cutting jobs, to be honest with you, right? But before I do that, I just a quick reminder, ADP employment report is helpful, but it has notoriously been a little bit deceiving. And so tomorrow we have non-farm payrolls come out. We will be breaking that down next Thursday for sure. And then a lot of retail sales data comes out as well. So definitely tune in next week. We'll see if this jobs data, strength kind of continues through this number tomorrow. However, I think what I wanted to address this week is a really good question of the week from Mary. And what this question is about is really about why is the Fed focused on basically reducing jobs, putting people out of work? That's a very harsh way to say it. And the Fed certainly says it in a much more, a much more soft way. But the Fed is trying to get the employment rate higher, right? Or the unemployment rate higher. And the question is, well, why, right? I mean, that obviously has some impacts on a lot of people. And so why would the Fed be focused on this? And there's a couple things that kind of come with that. So it's not so much about getting that higher. It's more the result of what that data point means. Right. The reality is if they are successful in this, it does mean a lot of jobs are lost. Right. There's a big discrepancy between job openings and people looking to fill them. And so that's part of it, is that the Fed is trying to find a more balanced labor market. Obviously, it's difficult on the other side of the equation. If there's that many job openings, it means that we are not as productive as we could be. And certainly there's more opportunities out there in the economy as a whole. But also, the main focus of this is that it can reduce inflation or have a little bit of a byproduct in reducing inflation. But again, it does have impacts to people. So that's really important to kind of keep in mind here. But typically, when the job market is this hot and there's this strong of like a hiring demand, what this leads to generally is increased wages. And as you might imagine, if wages are higher, that can fuel inflation, right? If we have more disposable income, more money to spend on things that we may or may not need, doesn't matter whether it's a need or a want, if we have more money to spend on things, that increases inflation. Think about everything as supply and demand, right? If we only have 10 apples and there's $10 in the world, those apples are probably going to cost $1 each. But all of a sudden, if wages pick up, for instance, and now it's, I don't know, $15, those apples eventually might cost $1.50. Now, very, very simple version of how this works, but you get the idea, right? If we have more money to spend and we're buying the same number of goods, generally those costs may come up over time. So the Fed is not, although this would happen, right? I mean, the Fed is not, I wouldn't say is hoping to get, put people out of work, although that is the result of what they're talking about, to be honest with you. But what they're trying to do is reduce the discrepancy in the labor market, therefore keeping inflation from growing too fast, and hopefully keeping wages from growing too fast, and hopefully therefore helping to reduce this pressure or this kind of push on the inflation numbers. So I thought that was really good. Thank you so much for the question here. I think a lot of people probably are curious about that as the Fed talks about it. So something we've never really covered before, but very, very important. So thanks so much for sending that in. And hopefully that helps explain a little bit of what's going on there. All right, we'll start to wrap up a little bit here, but definitely tune in next Thursday. Again, we have a very important non-farm payrolls number that comes out tomorrow. So we're going to break that down on top of the retail sales data coming out next week. Thanks so much for joining us. Have a great upcoming weekend. Enjoy the sunshine, and we will see you next Thursday at 3.